low leverage, relatively speaking, for residential properties.
Absolutely.
High occupancy.
Yep.
Discounted purchase, a huge opportunity for increase in rent, NOI that's increasing. This all sounds really, really good, but what are the risks? What are the risks here? If I own this and a year from now, you and I have a chat, we have a coffee and you go, sorry, Rob, it didn't go so good. I see that the fund's had a really good year.
Yes.
So what's happened this year in 2023? What do you say to someone who's saying, what if it gets worse?
What if it gets better, Rob? yeah.
Last question for you. What does the future look like for Equiton and for this apartment REIT? Hey guys, welcome to another episode. Today, I am pumped. We have a Senior VP of a Canadian apartment REIT with a phenomenal track record. I want to welcome Senior VP Geoff Lang. Geoff, thanks for being here today.
Yeah, thanks so much, Rob. Appreciate being here.
Equiton Residential Income Fund Trust. So this is an apartment REIT.
Correct.
It's been around how long?
Since 2015.
2015, so we're approaching on 10 years.
Correct.
It's got a long track record of Canadian investing and kind of focusing on apartments.
Bang on. Canadian multi-residential apartment buildings.
Why apartments?
Massive supply-demand imbalance in Canada. We all see it every day. It's in pretty much every major newspaper article, online and in print, that there's not enough supply in this country, too much demand, and leads to a nice tailwind for Canadian apartment buildings.
Now, you guys have had a really, really good long-term track record. I think your since inception number is around 11 and change.
We've done pretty well.
Yeah, so total return number in the double digits. You've also got, I think it's like 89 or 90 consecutive positive months of returns.
Absolutely.
So that return is obviously paying a distribution.
Yes.
How much is it returning?
Yeah, the fund is twofold. So we have our distribution, which is paid out on a monthly basis, about 7% on the F class, which is great because it's 100% return of capital. So very tax efficient for your clients. And then we expect about another 2 to 6% of capital appreciation on top of that, which falls into our target of 8 to 12% net of fees. And as you mentioned, that's what we've done since inception.
Currently, it's yielding 6.81%. So that's a pretty neat, and you've never had to cut on a cash basis the distribution?
Never.
Okay, so fund's been doing good. Now, the focus of the fund. Where are most of the assets held, and let's start with how big the fund is.
Fund is just under $1 billion, assets under management. The focus of the fund, or where the apartments are located, predominantly in Ontario. We have 32 properties, 30 of which are in Ontario, and then we have 2 other properties in Alberta, specifically in the Edmonton area.
Well, those are probably doing really good.
Yes, they are.
Yeah, huge year-over-year NOI growth out there, right?
Absolutely. No rent control. We've been very happy with our acquisitions in Alberta, and still, Ontario's done extremely well. NOI continues to increase, and there's still opportunity. We have a couple LOIs on 2 properties, one in London, Ontario, and then another in Bradford. So we're looking to expand the portfolio even more.
Okay, so how much is in the GTA, like the core downtown GTA?
Nothing really in the core downtown Toronto. We're predominantly in the greater Toronto area. So the Chatham, Kingston, London, Ontario, Hamilton, Burlington. We really love those areas. Why that is, cap rates tend not to get affected as much in the greater surrounding areas, the suburban, for lack of better terms. Good opportunity. A lot of the population growth is coming from, these areas of the marketplace. A lot of people moving out of downtown cores, and leads us to great opportunities when we're investing.
Let's look at the fund itself. There's how many doors would there be in total, roughly?
About 2,600.
2,600 doors, diversified, kind of southeast in that belt, a little bit in Alberta. What are you guys getting per door, roughly, in terms of rent?
Our average in our portfolio is about between 1,400 and 1,500 per door. So our revenue gap to market, or a good way of putting that is how below the market rent we are, is about 32%.
Why would you be that much below the market?
Because we're getting good value, we're putting our capital to work, and that all comes from our due diligence process.
So you're buying stuff at a significant discount to book, and when you're buying it, you're either buying it in a kind of some sort of distress sale or something like that?
Distress sale off book. Last year was our biggest acquisition year. We purchased 7 properties in 2022. Why that was, public REITs struggled.
Yeah, they needed to offload some stuff.
Or they weren't buyers in the marketplace, right? So what was in 2019, 2020, property up for sale, 15 to 20 bids, 2022, 2 or 3. So we're able to get a lot of properties off book at discount to fair market value, and that's been very accretive to the portfolio year to date.
When you're saying discount to fair market value, how are you measuring that?
So due diligence, a lot of buildings in the area, basically how we can go in there, see what capital expenditures need to be done. All of our valuations get done by third-party CBRE. So this is an Equiton doing the valuations.
So 32% discount to market value.
Correct.
So you're buying a property for $1 million. today and you get it appraised and it's 1.3 million.
That's the revenue gap to market of 32%. So as we turn over units and we do a renovation to the unit, we can increase the rent on average 32%. So that's very accretive to the portfolio. We still think that's a good way of looking at it. You know, it's going to increase the valuation, but having to, you know, as we turn over units, having that nice market rent bump is very helpful to the portfolio.
Let's talk about occupancy. What would be an ideal number for you guys for occupancy?
Right now we're 98%.
Is that a little too high?
No, not at all. We would be 100% if we weren't turning over units.
Yeah, no, I know you're turning over units.
Absolutely.
And people have to move and you want to move to get the rents up.
It's on average about 20% in the portfolio each and every year. And that's also a national average as well, right? People just move out for a variety of different reasons. We don't think it's too high at 98%. It means we're getting rental income, great for your clients, right? So there's a great opportunity there. And as I said, we turn over a lot of units in a year and we can really increase that rent.
Yeah, they're bringing over 1 million new Canadian residents every year, and almost no new construction builds right now. There's expected to be a huge shortfall, 500,000 units per year. There'll be, I expect this number to stay high for a very long time.
Absolutely. And to take it a step back, Rob, is we want high quality tenants in our portfolio. So as we turn over the units, we're not just welcoming anyone into our apartment buildings. We want individuals with high credit score rating, no more than 30% of their income going towards rent. We want high quality tenants, and our default rate in our entire portfolio has been less than 1%. We have renters that are paying their rent, and that's really impactful for your clientele.
Okay, everyone's worried about cost of capital, so interest rates. So what does your debt structure look like? And maybe start, what's the average borrowing cost across the entire book?
So our average mortgage rate is 3%, with a just over 7-year term to maturity. So we're not really too concerned about interest rates right now. We have no mortgages coming due in 2024, only 5 in 2025. The majority of the portfolio mortgage renewals around 2029, 2030. So we have a very good runway ahead of us.
So nothing for at least kind of 12, 14, 18 months.
And even the 5 mortgages coming due in 2025, the average rate is about 4.3%.
Okay, so it's not going to be a big bump.
No, it's not going to be a bump at all because we do 10-year fixed mortgages. And that rate right now is around that same mortgage rate we're seeing.
When you're doing your 10 years right now, are you doing any of this through CMHC? No.
Yes, we are. Yes, we are.
So the 10-year CMHC numbers right now are kind of right around 5?
Yeah, 4.5.
4.5, 5? So you're saying that even if this were to happen kind of today, the renewals, there wouldn't be a big bump on those 5 mortgages. Now, what do you say to someone who's saying, what if it gets worse?
What if it gets better, Rob? But what if it gets worse? Like, we try and create our portfolio as a risk mitigation tool. It's not like your massive alpha in your portfolio. It's just trying to get 8 to 12. We're comfortable where we are with our interest rates. Our debt service coverage ratios very well. Loan to value solid.
I was going to ask you about that next.
Yeah, loan to value is less than 50%. We're as well positioned as we've ever been, and no matter what the market cycle throws at us, we'll be okay.
So loan to value is around where you said?
47%.
47. So why so low?
It helps the portfolio. Yeah, it's conservative by nature. We can go, when we're acquiring a new building, we can go up to 60, 65, but we like keeping the loan to value less than 50%.
Okay, so you're using more equity, less debt to fund the returns.
Correct.
Which in theory should provide smoother returns in periods where the interest rates.
That's the plan, and we've seen that since inception so far.
What's happening to your rents year over year and then your NOI? So let's start with the rents. So you got 32 properties, call it 100 doors each, roughly give or take. What's happening to those rents year over year?
Well, rents are continuing to increase in the country, which is great for our portfolio. But from the standpoint of, we can only increase rents
on
really
turnover.
Impactively on turnover, right? But we're very happy with the rents that are coming in right now. Continues to increase. Our net operating incomes on our buildings continue to increase, and thus it should lead to another good few years ahead of us.
So do you know what your year over year rent kind of bump is on the turnover?
That I don't.
It would be double digits.
Yeah, it would be. It's in the quarterly report. That number I don't have
That's
off the top of my head.
Low leverage, relatively speaking, for residential properties.
Absolutely.
High occupancy.
Yep.
Discounted purchase, a huge opportunity for increase in rents. NOI that's increasing. This all sounds really, really good, but what are the risks? What are the risks here? If I own this and a year from now, you and I have a chat, we have a coffee, and you go, sorry, Rob, it didn't go so good. What happened?
Let's hope that doesn't happen, Rob, but I always look at interest rates, inflationary pressures. How are those funds protected? As I said, we use 10-year fixed mortgages. 5 years ago, did I wish we had variables? Absolutely, for sure. And we would have gotten that benefit as rates were going down. But we wanted to protect the portfolio going forward. So that's what we've done. And then when you're looking at alternatives, gating redemption seems like a popular form of conversation, right? What's the liquidity? We offer monthly liquidity on the portfolio, which is great compared to a lot of other alternative strategies. But with regards to gating redemptions, we have approximately 10,000 unit holders. We're a very well-diverse fund. This isn't 3 monster pension funds holding the billion AUM. And so we're well protected that way. And our management team is our largest unit holder at 4.5% of the fund. So they have skin in the game. So I think your clients would appreciate that as well.
Typically, this is paid out kind of a stable monthly distribution with an annual top-up?
Just stable monthly. No annual top-up, just a monthly distribution, very consistent. And as I said, 100% return to capital so clients can, and you and your clients can decide when to deem that taxable disposition.
I see that the fund's had a really good year.
Yes.
So what's happened this year in 2023?
So far we're up 9.64% year to date on the F-class fund, which we're extremely happy with.
Well, it puts you right in that 8 to 12 range, right? If you finish around the top
with
end
a
of
couple
range.
months left, Rob. So that's great. We had a really big Q2. The numbers came in, the value appreciation of the properties were there. And this all stems back to my comment of, you know, the acquisitions in 2022. We felt we purchased them at a significant discount to fair market value. This is all coming to fruition. This also has a lot to do with our due diligence methodology, and it's been a great year and look to continue it for the next couple months.
So I like this kind of stuff. You guys know me, those that have been following the channel. And by the way, take a sec to like and subscribe. You guys know that I appreciate real diversification, real assets that are uncorrelated to the stock market. We all own stocks, they go up, they go down.
Absolutely.
It's painful. If we could find stuff, I'm always looking for stuff, quality, competent management that can generate kind of 8 to 10, 11, 12% returns. That's a phenomenal wheelhouse if you could find it. Now, if you could also get tax efficiency through a return of capital distribution, if you could also get a DRIP reinvestment bonus, if you can get reduced MERs, if you can get RSP eligible, if you get monthly distribution, if you can get the leadership that you guys have, to me, that's all a bonus, which is one of the reasons I like working with you guys. I know who you guys are. I know where the money's going. I know the buildings that you've bought. I've toured them. I've seen them. You know, I'm confident that management is doing what it said it would. Last question for you. What does the future look like for Equiton and for this apartment REIT?
We have a massive runway. Like right now we're at $1 billion AUM, which is great because we can buy apartment buildings on the larger end of the spectrum, but we can still buy a $25 million townhouse community and still be very accretive to the portfolio. We expect a nice runway of 2, 3, 4, 5, 6 billion. We can deploy capital. We're approximately 70 million net year to date. So we have capital to deploy. And we're looking to acquire more and more buildings each and every month.
So are you planning on expanding outside of kind of the core southwestern Ontario?
Yes, we are. We're looking all across the country. We just had boots in the ground in British Columbia. The Vancouver market softened a little bit. So we're looking at some apartments in Langley, Coquitlam, Surrey. We've come to Manitoba before. It's beautiful out here. This is my first time in Winnipeg, and I'll be back. But you know, we also put an offer into a property in Quebec, in Laval. That one fell through, but we're trying to make our footprint more across country.
I like to hear that some offers are falling through. That means you guys are picky about the deals you're taking.
Yeah, we go through about 30 to buy one, is the math behind it.
8-year track record of generating over 11% returns, extremely tax efficient, monthly cash flow, real diversification, apartments, multifamily apartments. Equiton, thank you so much for being with me today, Geoff. Thanks for taking the time. And guys, don't forget to like, subscribe, and give me your comments below. Do you want to own apartment REITs? Is this something you want to participate in? Do you agree, disagree with what Geoff said? Let us know below. And don't forget to book your no obligation consultation. Go to www.speaktorob.com. Thanks for tuning in, guys. We'll see you in the next video.